Imagine you had $1,000 in 1980. You stashed it away in a sturdy little box under your bed, satisfied in the knowledge that you had a tidy sum for a rainy day. But here's the catch. You didn't touch it, didn't invest it, just left it sitting there. Fast forward to today, 2026, and you open that box expecting the same comfort you felt when you first hid it away. Here's what's surprising. What feels like a nest egg from the past is hardly enough for a simple shopping trip at today's prices. Over 46 years, inflation has silently eradicated your savings value, leaving you with more paper than power. So, what happened? Why does inflation wreak such havoc on your savings, quietly and steadily, without most people even realizing it? Inflation can seem like an abstract concept, a distant economic term that economists discuss on nightly business reports. But what's tricky about inflation is how it stealthily slips inside the front door of your finances. It affects everyone, yet few understand the true breadth of its impact until they feel it pinch their pocket directly. Essentially, inflation is the rate at which the general level of prices for goods and services rises. Consequently, it erodes purchasing power. Meanwhile, your money remains unchanged in its nominal amount. This phenomenon is what makes inflation so crucial to understand. If you're not strategic, inflation will slowly absorb your hard-earned savings over time without you ever noticing, until one day you find yourself wondering why you can't afford what you used to. Today, we need to unravel this mystery, discuss its implications, use real numbers to drive the point home, and discover the subtle ways inflation has been fleecing savings accounts for decades. In 1979, the United States faced a notable inflation spike, peaking at a rate of 13.3% in December of that year. To grasp this idea, let's consider the price of milk, which, at 100% inflation over time, doubled. Imagine that over a single year, your dollar can buy half as much milk as it could last year. If you're not getting correspondingly higher wages or your savings aren't yielding higher returns, you're essentially in a losing battle with time and money. Inflation, in this case, acts like a hidden tax, one you didn't explicitly agree to pay. For example, a dollar saved in a simple savings account that yielded just 1% interest annually would lose its buying power significantly as the inflation rate soared past 10%. That dollar wasn't working hard enough to keep up with rising prices. Your money, therefore, resides in inertia while the economic reality speeds past. In the late 1970s, to protect against such erasure, many began investing in tangible assets like real estate or bullion, items that hedge against inflation by maintaining intrinsic value. But here's where it gets weird. As inflation puts pressure on buyers, it simultaneously enables borrowers. Here's what that looks like. Consider the early 2000s housing boom. Housing prices were on the rise, fast, but inflation was relatively stable, averaging around 3% per year. This seeming contradiction offered a peculiar opportunity. Long-term mortgage borrowers were paying back their loans with future dollars that were effectively shrinking in real value over time. If inflation averages out higher over the years than the interest rate on your fixed mortgage, you're paying back your loan with money that's worth less than when you borrowed. This is contrary to the fate of plain savings. So, while savers saw the value of their saved dollars decrease, borrowers reveled in the decreasing real cost of their debt. Imagine borrowing $200,000 at an interest rate of 4% for a house. Over a 30-year period, if inflation hovered around 5%, you would repay your mortgage with dollars that were, in terms of purchasing power, less valuable. What began as a burden eased over time, paradoxically reducing the real cost of living expenses, including house payments. Wait until you hear this. Inflation isn't just about money making its slow escape, it's also exacerbated by unpredictability in a weirdly rational manner. In 2016, a study by economist Charles Goodhart revealed a curious effect of inflation dubbed the Goodhart effect. When inflation data is used as a target for policy, say, aiming for a 2% annual increase, the attempt to control it often alters consumer behavior in unexpected spheres. Let's dramatize this with a story-like example. Consider a bakery in your neighborhood. Suppose the government targets a 2% inflation rate that inadvertently impacts wheat prices. Bakers might then start bulk buying wheat as a hedge against inflated prices in the coming months. This bulk purchase promptly creates an artificial demand spike, temporarily pushing wheat prices even higher. Consequently, the price info used for setting policy ends up distorted by the same policy, a kind of economic self-fulfilling prophecy. Here, inflation doesn't just eat into savings through natural causes, it's also aggravated by collective psyche responses to economic strategies, shaping realities in ways policymakers didn't anticipate. Another twist. Predictably unpredictable, but persistently pervasive. Let's look at the cost to direct consumer products in terms of specific examples. In the late 1970s, high inflation caused a record spike in the price of commodities like oil. From about $20 per barrel in 1976, oil reached more than $100 in nominal terms, impacting inflation and thus energy costs globally. Fast forward to 2022, the average cost of a cup of coffee was $4.90, up from $1.38 in 1980, over 254% increase due to compounding inflated costs of production, materials, and labor. This reflects inflation-induced price creep trickling down directly into your cup from suppliers grappling with other inflating costs. So, as goods get more expensive and wages adjust slower or not at all, savings dip further when faced with meeting the same lifestyle the very next day. In an unyielding cycle, this makes it all too easy to drain bank accounts without overtly requiring extravagant purchases. Our everyday indulgences become silent facilitators of dwindling savings as we navigate hidden economic shifts. Here's a leap into the waiting explanation. When numbers tell a story you weren't expecting, you know you've crossed into intriguing territory. Did you know historical analysis suggests that even modest annual inflation of 2% can shrink your buying power in half over approximately 35 years? Keeping savings under normal productivity raises beliefs that marginal growth rates safehold savings. However, as articulated by the eminent economist John Maynard Keynes, a certain degree of inflation is necessary to encourage spending, thereby stimulating the economy. Yet, deflation, the opposite of inflation, plays its own cunning role. Consumers expect prices to fall further and might delay purchases, paradoxically slowing economic activity. It's like a dire balancing cycle perpetuated through accrued opportunities and moral clashes over holding versus spending, saving versus adapting. And now, the big reveal. Living in the through line of inflation calls not just for vigilance, but savvy maneuvers. Acknowledging inflation's invisible hand isn't simply about worrying over bank balances. Rather, it's about steering towards tangible actions to protect financial futures. First, if you're prone to savings, embrace diversified investments. Research showed that historically, stock markets tend to outperform inflation over time. For example, an average annual return of about 10% over nearly a century counteracts a significant portion of inflation's impact on purchasing power. Other viable approaches include Treasury inflation-protected securities, TIPS, which are directly indexed to inflation, ensuring the capital's real value is preserved. Moreover, boost your financial literacy by understanding asset classes that rise when inflation does. When you grasp that technology or healthcare sectors typically thrive in such conditions, you may align new investment opportunities strategically. Another surprising but effective hedge involves acquiring fixed-rate debt, now seen through a nuanced lens. Fixed rate means you repay with cheaper dollars later. Lastly, proactively seek raises aligned with inflation increases, an often underutilized facet. These actions tailor not just resistance, but resilience against the quiet storm of inflation, making a dynamic plan today for tomorrow's economic reality beneficial. Remember, ignorance is not bliss when it comes to your finances. Familiarize yourself with these intricacies, because when inflation comes knocking, it's best to greet it armed and informed, ready to keep it from slipping unnoticed into the fabric of our financial picture. Inflation can erode your savings subtly over time,